Okay, good morning, everyone. For those of you that don't know me, my name is Justin Nielsen, and a little bit of background on me. I've been with the company since September of 1997, and about 2 years into my stint as a customer service agent. I was actually supposed to only be there for 1 year, then I was going to go on to teach, but 2 years later I got this opportunity. Bill took me aside and said, hey, I need a new assistant. Would you like to be my assistant? And how can you say no to that, right? So that was September of 1999, and I've been Bill's assistant ever since. What I'm going to be sharing with you is what I've learned in my time with Bill over the last, 14 years now almost, 13 years, because I've gotten access to a lot of his trades, seen what he's done. I've sat with almost every single one of the portfolio managers on a regular basis and seen what they've done. And of course, I've gotten Bill to look at my own portfolio and tell me all the things I did wrong. So that's where my knowledge comes from. So what we're going to be talking about right now is portfolio management, and this is kind of what makes the difference between good and great and excellent. Okay? We can all start with the same stocks. In fact, in-house, the in-house portfolio managers, they all start with the same list. They all have the same list that they're working off of. But they can have vastly different performances. And that's because of portfolio management, the way that you handle your stocks after you buy them. That's what we're going to be talking about today. If any of you have been to any of Bill's seminars, you know that he talks a lot about rules, rules, rules. He says that over and over. That's the basis of Can Slim. You're buying rules, you're selling rules, but with portfolio management, there is a little bit more art than science. Okay? So what I'm going to be doing is I'm going to be giving you guidelines. I'm going to be trying to get you to ask the right questions. And I want you to ask these questions ahead of time, because the time to ask these questions is not when you're in the heat of the battle. Okay? When you're in the heat of the battle, that's not when you want to figure out how you fire your gun. Okay? You want to know how to do that ahead of time. So that's what we're going to be kind of talking about today. Now, this is going to fly in the face of what you might learn in the academic approach to stocks, but we'll address that in a little bit. So first off, capitalizing on your winners. This is what, again, has made Bill great. He's been able to capitalize on his winners, and the way he does that is he believes it's not about being right, it's about making big money when you're right. Okay? When I first started working for him, he had just had this very successful year. 1998 to 99 was a very profitable time period for him, and again, I got to analyze some of his trades. He had a ton of losers. Losing trades all over the place, okay, if you just looked at the individual trades. It was one of his best years ever because he had AOL and Schwab. And what he was doing was he was taking tiny losses on his laggard stocks and moving it into AOL and Schwab. And AOL and Schwab broke out in October of 1998. They both went up about 450% in 6 months. And they actually topped within a week of each other. One topped the week of April 9th, the other topped April 16th. So those were his big winners. And so, again, he didn't care that he had more losing trades because he made a bunch of money. Okay? So it's not about being right, it's about making big money when you're right. It kind of tickles me a little bit when you see the advertisements kind of saying, oh, we've got a 95% accuracy, that you're going to have a winning trades on these. Well, who cares if you have all these winning trades if you're not making big money on them? Okay, so that's a big point. So the goal is to find the leaders and move more money into those stocks. And now properly executed concentration, not diversification, is the key, while having rules to protect us. Go ahead and underline that. The rules is your protection. Okay? Sell rules specifically. Market timing rules specifically. That's where our protection comes from. How many of you are a little, and you can be honest, I'm not going to fault you for it. How many of you are a little uncomfortable having a concentrated portfolio? Okay? Yeah. It's a little scary, right? Especially because everything you're told is don't do that, right? So we've got all this academia telling us not to do that on one side, and we've got Bill saying, no, it's okay. To Bill, he believes it's only risky if you don't follow your rules. Okay? He believes that he's taking less risk, actually, in this way. So for those of you that might have doubts, one of the things that can happen with portfolio management is if you let doubt creep in, if you let emotions creep in, that's going to kill you, right? We all know that. Emotions is what kills you in the market. So let me just kind of address some of these things. If you studied modern portfolio theory, and this is not in your books, by the way, because if I put something about modern portfolio theory in the book and Bill saw it, he would say, what the heck are you doing? But I just want to kind of try and remove some doubts right now is my goal. You'd see an equation, something like that, okay? If you're a numbers person, this stuff is great. But so here's what they come up with. And this is a study done back in 1977. This is really the basis for modern portfolio theory. The idea that you have too much risk. The way that they measure risk is standard deviation. And risk in a portfolio class does not equal a negative thing. It's just uncertainty. okay? It could be up, or down. It's just how much it deviates from the mean. So if you have one stock, you get this huge standard deviation, 50% swings. If you get two stocks, it goes less. Well, if you get 1,000 stocks, it goes down to 19% standard deviation. This was the result of this study back in 1977. And so people thought, well, the more stocks you have, the less risk you have, which makes sense, right? But now think of this in your own portfolio. When you have 10 stocks, you can know them pretty well, right? What happens when you have 50 stocks? It's a little bit tougher to keep track, right? So two big problems I see with this. One thing I also want you to just kind of note real quick is with 8 to 10 stocks, you're minimizing the risk by half. You're cutting that risk down by half. So that's kind of our sweet spot, I think. 8 to 10 stocks right there. You've cut your risk, the standard deviation, in half. Okay? And a couple things that are the premise for these numbers that they did. People are starting to call this into question now. But two main things. This is assuming a buy and hold approach. So of course, if you buy and hold through a major correction, you are going to have larger standard deviations. You're going to have a larger risk. Okay? And there's also this increased positive correlations of crisis. The concept behind this is that you've got stocks that are doing different things. Okay? And that's where your risk gets lessened, because you have one stock that's going up and you have one stock that's going down, and they kind of balance each other out, the risk. But here's what I want you to think about. What happens when the market is going down? Or a crisis, a market correction, a major market correction? They all get hit. They all get hit. And so what happens is they have a more positive correlation, and so you lose the benefit of diversification. Now, at the same time, what this does to your returns is it waters down your returns. Again, I don't want to get too geeky here. I just want you to understand why we're different. It's not to say that I'm arguing with the numbers, but there's a reason why we do things the way we do them. Here's some statistics for those of you that have been to market school. My only point in bringing this up right here is just to show you what market timing can do for you in terms of reducing your risk. So here's the NASDAQ composite, a buy and hold approach in the NASDAQ from June of 1973 to current. The average annual return compounded out is 9.08% during that time period. The standard deviation during that time period is 26.6%. That's the market, the NASDAQ market. With our market school model, because we time the market, because we stay out of those major downtrends, we get a better return, 13.85%, which compounded out over that time frame makes a huge difference, by the way. And look at what happens to our risk. Much less, 14.4% standard deviation. Again, I just want you to kind of feel a little bit more comfortable with having 8 to 10 stocks is my point here. Okay, now greatness isn't achieved with a 20-stock portfolio. One of the reasons why is because if you've got 20 stocks and you have equal dollar amounts in them, then you're looking at about a 5% position size as a percent of your equity. So if you get a big winner and you get 100% gain on that big winner, how much of a difference did that make in your portfolio? 5%. Again, when you get that big winner, we want it to make a difference in your portfolio. So that's why we're going to stick with the fewer stocks. Now, some of this is going to depend on your risk tolerance level, and I've got some charts in the book that can kind of help you gauge this. But I want you to make these decisions ahead of time. I don't want you to decide when the stock is at its bottom, oh, that risk tolerance level is too much for me. I want you to think ahead that this is what is normal for a stock to do, so you're prepared for it. I often liken it to the punch in the gut. With a lot of these stocks, if you're buying these leaders, I use CME as an example. CME, when it came out in 2005, it had this like 43% move very quickly. And afterwards, it corrected 16%. That's very normal for a stock to do after it goes up 43%. But if you were sitting in that stock, it would feel like a punch in the stomach. And now you have a choice. You could either say, I know this is possibly coming, so I'm going to tighten my stomach up, or you can just let yourself go flabby, and it'll knock the wind out of you. So I want you to start preparing yourself, start getting your abs in shape, and prepare yourself for these punches that come. Because if you don't prepare yourself, think about it ahead of time, you're going to make bad decisions, and you're probably going to sell at the bottom. So how many stocks do you own? This comes straight from How to Make Money in Stocks. If you have less than 200,000, maybe 4 to 5 stocks. 200,000 to 1 million, 5 to 6. 1 million to 5 million, 6 to 8. And over 5 million, 7 to 8. Our in-house portfolio managers, Bill, they're dealing with a decent chunk of change. And Bill loves stories that a lot of times after he's done speaking, he'll have someone come up and very nondescript, the guy's wearing jeans, doesn't look like he's got that much money at all, and he'll come up and say to Bill, now, Do you even mean that for a $23 million portfolio? And Bill's like, yeah, I do. I'm dealing with some money myself, and this is what I do. This is the way I trade. He's not going to recommend something for you that he doesn't do himself. But again, you have to have the rules. You have to have the sell rules, the market timing rules, because if you don't, then your risk gets much larger. Okay? There's not any academics in here, are there? You know, like, okay, so when people do say, that's not what the professors say, that's not what the academics say, he says, how many wealthy professors do you know? How many professors do you know that have made a lot of money in the market? Okay, so this is going to be the way we do it. Now, I have end result right here, and what I mean by that is sometimes we will start out with more stocks, and our goal is to kind of funnel it down. There have been times where I've seen Bill start out with maybe 12 stocks because he's not quite sure who the leader is. And so he might have a couple different stocks from the same group, and then the one that goes up the most, the quickest, oh, that's the leader. Forget that one. I'm putting my money into that one. So that's how he kind of does a funneling approach. As you gain experience and competence, you may want to narrow your stock concentration even more, especially after you have some cushion, especially after you've made progress in the market. You can narrow it down even more to those few leaders that are really, really working. I've seen Bill do this. You have to have your limit, though. Have your limit ahead of time. You don't want to get crazy because you have to have a certain level of discipline in order to do this. I have seen Bill very heavily concentrated in just a few stocks, even one or two. He doesn't do that so much anymore. Probably the last time I saw him do that was maybe back in 2006 with like Apple and Google, where he had pretty much his whole account on margin in those two stocks. It's not something he does very much anymore. But I also know that if he sees sell signals, if he sees something that looks funny to him, he's going to get out of that position. It doesn't matter how big his position is. He's going to get out of that position in probably under 4 days if he's feeling uncomfortable by it. And the other thing, too, is he's not plunging. He's not putting all that money to work at the same time. And so we're going to learn that in pyramiding. A couple other risk considerations with any account. You want to minimize your exposure to thin stocks. What do we mean by thin? Anything trading under 500,000 shares a day, average daily volume, we consider on the thin side. We're not saying you can't buy these stocks. You can. Just don't have a whole portfolio full of them. You want to just minimize your risk to those because they can have big swings. And again, you have to be prepared for that. Especially with a thinner stock, it can have these big moves up and it can have these big moves down. And if you have a whole portfolio full of them, you're probably going to be putting more emotions into your decisions, and you're probably going to mess it up. So be careful of thin stocks. And if you are dealing with a larger account, you might want to limit your position size as a percentage of the average daily volume of the stock. So this is something that I learned from Steve Birch originally, about 3 to 5% of a stock's average daily volume. And I had the benefit of sitting next to Charles Harris for a while, too. I learned this in a more concrete way from him. We were sitting next to each other, and I'd see him sweating bullets because he was in a stock that he wanted to get out of, and he was afraid that he was going to hit the stock because he had such a large percentage of the average daily volume. And so this was back in the day when you had to call up the broker. It wasn't put my online trade on. So he'd call up the broker, and I'd hear him say, okay, sell XYZ stock, this many shares, and then I'd type up on my computer, oh, boop, there's Charles. I could see the volume spike. And the problem was that he'd be hitting the stock. And he'd be afraid that he was going to start other people selling because he was going to make the stock get hit so hard. So you have to just limit your position size to a certain percentage. We stick with 3 to 5% of the average daily volume. Once you start getting more than that, you're going to be the blip. And when you stick out on the volume, that's not necessarily a good thing. Okay, trading on margin. How many of you trade on margin? Decent amount of you. So how many of you have felt the positive effects of margin and how much it can make a difference on your account? How many of you have felt the negative effects of margin? You live by the sword, you die by the sword. It can really enhance your performance, but it can also make you lose money very quickly. You just have to have a very healthy respect for margin. A couple things that you should know. Only use it in healthy bull market advances. You don't want to start at the beginning on margin. By the way, I have done that. I did that in 2001 and 2002 a couple times. Not a good idea. In fact, I should say what I was really trying to do was I was trying to get revenge on the market because I had lost some money, and so I'm like, well, I lost some money, so the only thing I can do is double down and make that money back. That's not the way to go. It should only be used in healthy bull markets once you have some cushion. That cushion is critical because the last thing you want to do is let margin start digging into your capital. We want to protect our capital at all costs. That's why we have the 7% rule, the 8% rule. We don't want to let margin dig into our capital. You have to have a decent cushion before you start dealing with margin. And you have to have a healthy bull market. You don't want one of these markets where it's choppy. You're going to get chopped up in that case. You're going to be getting in and out, and you're probably going to have more emotions involved, and it's going to kill you. So when deciding if it's right for you, consider your investing experience. You want to have a little bit of investing experience under your belt before you start this. This is not something that you want to say, hey, I think I know all the rules. You want to have a demonstrated level of discipline. Not that I think I will do this. I know I will do this. I know I will sell. So just go ahead and underline that demonstrated in your books. And again, this is where Bill, when I've seen him get super aggressive, he has a demonstrated level of discipline. He does not hesitate when it comes time to sell a stock. It doesn't matter how much of it he has. It doesn't matter how wonderful he thinks the company. And Bill's human. You can tell when he's in love with a stock. You can absolutely tell the way he talks about it, the twinkle in his eye when he speaks of it. You can tell. And he does get, yeah, this stock is amazing. But then, if he sees sell signals, he's got a demonstrated level of discipline. He doesn't care. And when you mention to him, Bill, 2 weeks ago you said this thing was the greatest thing since sliced bread. Yeah, well, now it's got this and this and this, so it's crap, kind of thing. He changes his mind on a dime. By the way, this is also why I recommend never take a tip from Bill. Because if you do, what happens is he gets in your head and you're like, well, if Bill likes this stock, then it must be a good stock. He will never call you up when it's time to sell. That's something he's just very quiet about. He does on its own. He doesn't tell anyone when he goes negative on a stock. You just find out later, oh yeah, I sold that thing long ago. The strength of the general market. You want to have a strong general market. You not only want your account making progress, your portfolio making progress, but you also want the market to be making progress too. You want as much things in your favor as possible because you want the right environment if you're going to be using margin and getting that aggressive. And also whether you're not in a financial position to take on that additional risk. If you're like, okay, I need to make this money because I got a loan shark that I got to pay back, that's not the time to be going super aggressive on margin or anything like that. And of course, you can ease into it, raise your comfort level. This is not something that you have to do all or nothing. Either I'm going to use margin fully, 200% invested, or I'm not going to use it at all. You can kind of ramp it up. You know what, this market, I'm going to try as a goal to go up to 115% on margin if the conditions are right. Whenever you set a goal for yourself, by the way, that I'm going to try this, make sure it has that caveat, only if conditions are right. Because if the conditions aren't right, don't force it. Don't be forcing any round pegs and square holes here. You want to make sure that the conditions are right for it. So, establishing position sizes. How do we get started? How do we establish our position in a stock? Well, what we're going to do is we're going to have a target number for our position size as a percentage of assets. Here's the way we can do this. And this is our starting position that I'm talking about right now. This is something that we've talked about a lot. If you've got a cash account, $5 million in your portfolio, and when you get 100% invested, if you're going to have 8 stocks, that means you're looking at a 12.5% position as a percent of your equity as your starting point. Okay? And so you got to decide, is that something I can handle? If you're 200%, if you're going to allow yourself to get 200% on margin and still try and limit yourself to 8 stocks, your starting position might be 25%. And that, for some people, is too much to start with. So maybe you go to 150 and say, okay, this is something I can deal with. And you can increase the number of stocks that you're going to start out with at the beginning, and maybe you're going to only have a 10% position because you've got more stocks that you're going to allow for. And again, this is your starting point. Or you're only going to be at 20% on margin because you're dealing with more stocks. And the benefit of doing this is it gives you a little bit more room for your ads and also just keeps you from getting too heavily invested in a single stock beyond your comfort level. Because 2 things can happen. When you get a leader, you're going to be adding to it, right? And those ads are going to increase the percent of your equity, number 1. But also, that stock will probably be one of your biggest winners. And so by the nature of how much it's gone up, it's going to also increase your exposure to that particular stock. So you have to keep in mind those 2 things and give yourself a little bit of room to add to the leaders. Did you have a question? We're going to get to that right now. He's asking, does your target go up? Yeah, this is your starting position. This is where you want to start at. And you want all of them to start the same because you don't know who the leader's going to be. Just like a horse race, when the bell rings, they're all starting from the same position. I actually used to go to the horse races with my pappy. He was a big horse race guy. And in fact, this was back in the 80s, and he had one of those very early pocket, Tandy I think made them, these pocket computers, and he would actually put in there all the statistics for the horses and come up with who he thought was going to be the winner. So he really loved the horse races. But the idea is that once the horse race starts, you can quickly find out who the leaders are, right? Well, the benefit in the stock market is that we get to change our minds. If we put our bets on all the horses at the beginning, well, halfway through, we can change our bets. You don't get to do that at the horse track. We get to change our bets and put our money into the leaders and say, okay, now we're going to have our bets on these guys. So, yes, that is your starting position, and you do want them to kind of start at the same starting point. But this target number should be raised significantly with your best leaders as you add to them. But I still want you to have a limit. Still have a limit in mind, because I don't want you to get overly concentrated in something beyond your risk tolerance level. Again, you need to think this through, think ahead of how much of a drawdown you might be taking in your portfolio based on how concentrated you are in a single stock. You have this little chart here to use as a guide. Just real quickly what it is, and I want you to kind of look at this at home and kind of make some decisions of, circle what you're comfortable with and X out what you're not comfortable with. Let's say you have that 20% position, starting position. Well, if you cut all your losses at 8%, you could be looking at a 1.6% drop in your equity. And so now whatever your portfolio is, turn that into a dollar amount, because you probably will look at the dollar amount too. Is that something you can handle? If you've got a $100,000 account, if one of your stocks goes down 8%, that's going to be $1,600. Are you okay with that? Usually I find between 2 and 4% is very easy. Well, not very easy. I don't like losing money at all. But 2 to 4% losses of your equity are okay to handle. When you start getting above that, it starts getting more difficult. So right now, I keep my limit, my upper limit. I don't want to be more than 35% invested in any single stock. That's kind of my gauge, 35 to 40%. And that's going to be one of my leaders, right? I'm going to maybe have a starting position of 20%, and I might let it go up to 35%. So if that's one of my leaders, what kind of correction could I expect? You remember, about 16, 17, maybe even up to 20%, okay? That can happen, right? So now I have to look at my chart and say, what is that going to do as a percent of my equity? What kind of drawdown am I going to look at? Well, if I've got 35% of my equity and I get a 20% drop, that's a 7% drop in my equity. Put a dollar amount to that. If I've got $100,000, that's a $7,000 drop. Can I handle that? Because now it's starting to get to be a little bit more uncomfortable, right? So again, I just want you to kind of do this ahead of time, determine what your risk tolerance is, X out things that you know what, this is too much for me. Think ahead, okay? Can you go ahead and put up INVN real quick? Here's an example. Right now, INVN is one of the stocks in my portfolio. I'm not saying that you should go out and buy INVN. I just happened to buy it. I bought it right. And one of the things that's kind of tough about this is that it's been one of my leaders, so I've had more of it in my account, and these drops are not fun. Now when these drops happen, I know, I'm looking at the chart and I'm like, you know what, it's not doing anything wrong. It hasn't broken the 50-day, it hasn't done I'm going through the whole list of the things that it hasn't done wrong, but it still feels like a punch in the gut. Luckily for me, I was able to hold through it because I knew that that was possible. After a big move up like that, I knew, hey, a punch in the gut might be coming, and I tightened up. I'm not going to say that my abs are in the best shape right now, but I at least knew to tighten up a little bit on that. This is a larger percentage of my account right now, and so I've been looking at larger drawdowns. That was something I was prepared for ahead of time, and because of that, I didn't sell at the low. Otherwise, I know myself, I would have sold at the low if I hadn't thought about that ahead of time. Okay. Periodically evaluate your position size percentages as you make progress in your account. Again, this is a good way to look and see, am I in the right stocks? Am I in the right level, percentage of my equity in the leaders? Which stocks am I in the heaviest? Which ones am I in the lightest? And make adjustments. This is a thing where you should constantly be making adjustments to your account. Now, one other thing, don't raise your dollar amount, your starting position necessarily, just because you've made progress in your account. For instance, if you had $100,000 as your starting portfolio equity, and you went up 50%. And let's say that you were saying, I'm going to start every position at 10%, just to make it easy. So that's a $10,000 starting position. Now, you make progress in your account, and you're up 50% on the year. Well, you would say that my starting position should now be what? 50% more, right? 15,000. Well, if you keep on doing that, what's going to happen is your newer stocks, the ones that you're just buying, are going to start being a larger percent of your equity than your leaders. You're going to get out of whack. The other thing that can happen is that at the top, that's where you're going to be getting super aggressive. You've made a lot of progress in your account, and so when the drawdown happens, which it will, you'll get some type of drawdown. We're not teaching you to sell at the very top. We're getting within a range, right? So you just have to know a drawdown is coming, and if you get super aggressive by always increasing your dollar amount to match the new percent of equity, you'll get overly aggressive. As the market continues to go up, you're getting later and later in the cycle, and so it's okay to get a little less aggressive at the start. Now, that does give you more room to add to your leaders as that becomes apparent. Again, it might seem a little counterintuitive, but we'll show you some examples of this in the simulation. And I'll be honest with you, this is something that I didn't realize until I worked on the simulation with Bill. When we did this for the level 4, for those of you that remember, we used to do that. I'll tell you, in my whole time with Bill, the things that have been the greatest things for me in terms of learning experience was working on How to Make Money in Stocks, the 3rd edition and 4th edition, and The Successful Investor, those books with him, because you just sit down with Bill and go through tons of charts. I mean, how great is that, right? And then also the simulation. Just learned so many things from those experiences. But this was a big one that I didn't see anywhere in his books. It was something that he just said, I created the simulation in a certain way, and he's like, what are you doing? You can't do it that way. Granted, it made our performance really great and stellar, but he said, nah, that's not the way to do it. So I just want you to be aware of this. And most of you already know this. When we do our initial position, we do it in a pyramiding fashion. If you're going to have a $10,000 starting position, each of your stocks is going to have $10,000 in it to start. You're going to start with $5,000 right around the pivot, and when it goes up to 2.5%, you automatically add. That one is automatic. I'm not sure how many of you were at, I think this was the first level 4 that Bill did. One of my favorite examples of him really getting involved and engaged with the audience was he talked about this being the 1-2 punch. And so what he did was he actually came down the aisle, and he was like a boxer. And he says, when the boxer's fighting, it's not the first punch, it's the follow-up punch that gets him. This is always automatic. And then you're going to follow it up with $1,500 to $2,000 for your final buy, about 2.5% above that. So if you buy right at the pivot, that means you're going to get your whole position within 5% of the pivot, and that's what we want to do. If you do it this way, you are going to raise your average cost a little bit, but because you're buying less at these second and third buys, you're not raising your average cost too much. In fact, if you do this right at the pivot, or fairly close, you shouldn't be more than 1.75% above the pivot if you do it this way, okay? 1.75%. So you're within 2% of the pivot. And starting right makes all the difference. If you don't start right, if you start extended, you buy a stock extended, it's real easy to get shaken out. 40 to 50% of them pull back. So starting right is absolutely critical. And here's another thing that happens. A lot of people ask me, okay, the 7 to 8% rule, do you apply that to your average cost or to each individual decision? Well, the way that Bill does it is he does it with his individual decisions. Usually, there are some exceptions. For instance, if you've got a stock that goes up and you make your first purchase, and then it doesn't go anywhere, now you've only exposed half of your full position, and so you haven't gotten hurt that much if it doesn't work out. So that's one benefit. Now let's say you get a full position. So you get buy 1, buy 2, buy 3, and you're going to see this in the simulation. We're going to have B1, B2, B3. So buy 1, buy 2, buy 3, and now you're fully in, and let's say it comes down a little bit. That's not unusual. That happens a lot of times. But what you can do is you can just sell your last position if you get down 7 to 8% on that last buy. And the way that Bill does it in his head, or actually has the accounting department do it for him, is he's saying, I'm going to keep my lower average cost stock. He just basically lops that off and says, okay, now my average cost is just these two. This is true also as he's doing ads. So let's say it pulls back to the 50-day, and then he buys some, or it comes out of a 3 weeks tight, and he buys some, but then it goes down 8% from there. But he still has this lower average cost stock down here. So he's going to say to himself, you know what? I was wrong on that decision, but I'm still right on this stuff. So he's just going to get rid of that last decision. So a last in, first out type of accounting is the way he does it. And that's the way he also calculates his average cost. He will not say, okay, I lost money on this, so now my average cost is higher. He's just going to say, you know what? I kept my low average cost stock. When we were building the simulations, Bill told me that usually the B1 and the B2, he's totally fine with that being on the first day. If it's got a lot of power, the fundamentals are really strong, and he really believes in the stock, maybe he'll do that B3 on the first day too. But a lot of times, he waits on that B3. So again, this is automatic. The first two are automatic. If it goes 5% the first day, and by the way, I just have to let you know, my answer to a lot of questions is going to be it depends, especially in portfolio management. So it depends. If it bumps up to 5% on the first day, then It depends, again, on his conviction, and David's going to cover conviction in the next section. What do the fundamentals look like? What did the base look like? If it's one that he really believes in, he might do it. But a lot of times what he does is he just, let me wait and see if it comes in a little bit, see maybe how it trades at the end of the day. So maybe he'll put it in on the last half hour or something like that. I've seen him do it a couple different ways. So that can vary. But the first two doesn't vary at all. Also, I've seen if it takes a long time for it to get to that 5%, it takes a long time for him to get to his B3, that might make him a little bit less engaged with the stock. Now, there is a certain amount of patience that you're required to have. Some stocks don't just skyrocket in the first week. Some take a little bit of time. But I have noticed that if it takes a long time for the B2 to happen, that might mean that he moves on to other stocks. That does happen. One of the things I would recommend you do on your chart is keep track of your average cost and plot it on your chart. You've got to put less shares involved on your additional buys because you don't want to raise your average cost. But knowing where my average cost really helps me out. I especially look at my average cost in relation to my 50-day moving average because I know pullbacks to the 50-day are very normal, right? I have to expect that. I've got to have my stomach tightened up for that, right? And if my average cost is above the 50-day, then I know I might have gotten a little out of whack and I might be having to sell more if a normal correction happens. And by the way, I should also mention that there are times where if it is coming in, although it's absolutely normal, Bill might scale back a little bit. He might scale back just because, you know what, I don't want to be this aggressive on this stock just in case this is a more serious correction. Even though it's normal, I'm going to hold on to my core position and maybe a few of my additional adds, but sometimes he will back away a little bit. He's very fluid, very fluid. He's going to bend with the breeze of the market. And that's, again, one of those things great about Bill. He will never stick to his opinion. You know, if he has an opinion, one day he'll change his mind when he sees evidence to the contrary. In the same way that he might back away from something as it's coming in, just to be a little bit less aggressive. If he sees strength come back into that same stock, he'll be buying it back. Even if he has to buy it at a higher price than he sold, he's going to buy it back. Yeah?
It's an automatic buy.
Yeah.
You typically put it
Right. This question comes up a lot of times. Those of us that have to work for a living, right? We can't just sit there in front of the market all day. Of course, there's a lot of extra tools that we have now. You can get little beeps on your phone that tell you, oh, and you can actually make a trade, so got to go to the restroom, buy XYZ, you know. We've got some things that have made it easier. I think that there's no problem using buy limits in certain situations. Bill does not like to use them because he believes that this is a poker game and he does not want to show his hand to the specialist. He thinks that when he puts that order in, the specialist, oh, that's what Bill wants to do? I'm going to try and mess that guy up. So he doesn't want to show his hand. But I think for most of us, you know what? I personally use sell stops a lot. Again, that's something that Bill would never do. But I travel, and sometimes the cheapest flight is during market hours, and they make me get on the cheapest flight. And so I'm going to be in the air, and the last thing I want to do is land and find out, oh, guess what happened while I was flying? So yeah, I put sell stops in and stuff like that. I don't think that anyone's coming after my 100 shares. He doesn't use them, but I think it's okay. And also, I think a lot of brokerages now have trade triggers, because another thing that, at least at the pivot, one of the problems that we had with using buy stop limits is that you didn't have a volume component. It was just if it crossed the price without volume, then you'd be in a stock that maybe you didn't want to be in. Although, it seems like a lot of stocks are breaking out without volume right now. But I think there's brokerages now that have trade triggers where it can say, okay, I've got to have both of these and then put the order in for me. And a lot of those trade triggers, it also keeps it off the specialist books. So Bill would probably actually like that. It's on your brokerage books, but not the specialist. Okay. So you keep your additional buys smaller, and that keeps your average cost low. Again, he looks at it as a core position, and he's adding to that to get a little bit more aggressive. Don't chase a stock more than 5% past its pivot. I'll say that the only exception that I've maybe seen to this is with breakaway gaps, and you'll see some examples of that in the simulation. If there's a breakaway gap, a lot of times, again, if Bill has done his research, he knows the company, he knows the fundamentals, and he believes in the product and everything like that, he might buy it anyway. He might do it in a different way. He's not necessarily going to start B1 and then do all his follow-up buys in the same way. Maybe he'll do a little bit more on the first buy, and maybe he won't do 3 buys. So there's a couple different ways he might handle a breakaway gap. Yeah?
Well, it says stock more than 5 to 10%.
It might have been to take into consideration the gap. I'll be honest, gosh, that doesn't sound like Bill, you know? Yeah, it really doesn't. I'm kind of surprised to hear that. Can someone verify that for me? Did you guys read that? 5 to 10%? Yeah. He's saying that in the book, he saw a change that it was saying, don't buy 5 to 10%. above the pivot. I know if I buy 10% above the pivot and I show Bill that trade, he's going to say, what were you doing? And again, the only exception might be with a breakaway gap.
My recollection is it never chases it higher than 10%.
Yeah.
Buy it, rid its teeth.
Exactly. What Lee was saying here is that what Bill said was the 10% was for the breakaway gap and that he grits his teeth. There is a chance that it's going to come in and fill the gap. With breakaway gaps, that's usually a positive indicator, and he knows that that's a huge amount of demand coming into the stock. That's the kind of stock he wants to be in. But he also knows that there's some additional risk. He's not getting it in the exact right spot. Again, this is where it depends. You know, it depends on the stock, how well he knows it, the liquidity. If it's a super thin stock, he's probably going to pass. To Bill, thin is anything under 1 million shares. He tries to stick with 1 million and above average daily volume. Again, a lot of that is going to depend. Okay, don't chase the stock more than 5% past its pivot. Don't vacillate at the pivot. Hopefully you guys are doing your homework ahead of time, and so when the pivot happens, you're just pulling the trigger. And if you're not, change that, okay? Do your homework ahead of time. When it crosses the pivot, and I'll be honest, I was very guilty of this at the beginning. I would see stocks coming up on stocks on the move, and then it's like, oh, I don't remember that stock. Then I do my research and try and pull the trigger within 5 minutes because I didn't want to miss it. And that's not the way to do the research. You've got to give yourself time, not be as emotionally involved, but at the same time, don't hesitate. Once you've done your research, don't vacillate. Just pull the trigger. And then, as I mentioned before, every first purchase must be in equal dollar amounts. Yeah? Good question. If it's an IPO stock, would you still do an equal percent purchase? I have seen Bill sometimes play with that a little bit because maybe it's an IPO stock, so maybe he does a little bit less until it has more trading history. So if he knows that he's taking on a little bit additional risk, he tells people to do always equal, but in practice, I have seen him do less in situations like that with IPO. And again, that's where it depends. There's a lot of art to this, but he's still going to have a meaningful position. He's not going to do a 4% position in it. He's still going to have a meaningful position, but maybe a little bit less aggressive starting point. If it shows promise, he might actually do a normal position size, and if it's moving, you better believe he's probably going to be funneling money into it. Yeah. Well, of course, yeah. So he pointed out, when I say don't vacillate at the pivot, volume is absolutely a component of that. And again, volume's been a tricky thing. In most of the cases, at least what we've had recently, is volume comes in somewhere around the pivot, maybe a couple days earlier. I think that happened with Celgene. The volume came in like a couple days earlier or a couple days later. Or when you look at the weekly volume is huge. So Bill has made some allowances for that, but typically, you want to see that volume in there. In fact, Mike and Charles did a study, I don't remember how long ago it was, but volume was one of the most critical components of success for the stocks. But again, this is kind of a weird situation where some of the stocks aren't showing that. And again, I don't want to get too geeky on you, but I personally like Excel a lot. I put a lot of things in Excel. What I do is I kind of will have a sheet that is kind of my worksheet where I can plug numbers in and have it tell me what's going to happen here. So what I do is I'll say, okay, here's how much money I have, here's what my investment limit's going to be, so this is what the starting position's going to be, this is what my follow-up buys are going to be, so all I have to do is plug in the pivot, and it'll tell me how many shares I'm going to buy. It's kind of all automatic. And then what I do is I put my actual purchase price in there. This is what my target price should be based on the pivot. I put what my actual price was in this yellow right here, and it'll calculate for me what the 7% loss is, so I know on each one of my purchases what my 7% loss is, and my average cost. Then I have a place here where for additional buys, if I'm going to do an additional buy, I'll do it here first. Okay? If I buy this much at this price, what is it going to do to my average cost? Again, I use Excel to do this. Bill, he does it on paper. He does not use Excel. He doesn't even use a calculator. If you ever see his sheets, he's got math all over the place. He just does it by hand and calculates this out. So he's always thinking, okay, if I add this many shares at this price, what is that going to do to my average cost? It's something he's constantly calculating. I'm just a little bit more lazy, and I do it in Excel. It takes a little bit more time to set up, then once it's set up, it's real easy. Okay, we already talked about this. The downside of a 4 or 5% position is if you get that big winner, you don't have much money in it. As opposed to having a proper position, let's say 12.5%, you get a big winner. That's going to make a more healthy change to your portfolio. On the follow-through, I know that we just went through this horrible year where there were all these follow-throughs that didn't work, and we know this happens. We know this happens in certain environments. Now, with these portfolio management rules and guidelines, what you should find is that when you're not making much progress in your account, you're not getting very heavily invested. Okay? Is that happening for you guys, hopefully? If you're getting heavily invested and you're only up 3%, that's not the way to go. Okay? You have to have progress in your account before you get more invested. In fact, that's why that pyramiding purchasing model works very well, because you're only starting with a half position, and it's not until the stock is making progress that you put more money into it. Same thing with your account. A follow-through happens, maybe you buy 1 or 2 stocks, and you wait and see how those go. Okay? And if you make some progress on those, then you can buy some more. It is true, a lot of times you are, and this is okay, you're going to lag the market averages at first because you're not going to be fully invested. So if you compared yourself to the market average is getting the full benefit of the percent gain, and you're only getting part of the benefit because you're only partially invested. That's okay. Once you get more progress in your account, you're going to get heavier and heavier invested, and if you're buying canned slim quality stocks, then you're going to quickly find yourself outperforming the market. When I look at my equity curve, and I'll show you what that looks like in the post-analysis, that's what my equity curve looks like. It's a little bit slow to start, but then it catches up and surpasses the index. Yeah? Okay, so he's asking about tradable rallies during bear markets. Well, unfortunately, you don't really know it's a tradable rally until after the fact, right? When you get the follow-through day, you have no idea if it's going to be a tradable rally, if it's going to fail, you don't know. So that's why we try and do the same thing. We're going to buy, but we're only going to be putting more money in if it's working. But you have no idea what's going to happen. You should also, and I'm skipping ahead a little bit, but you also have to have something to buy. With some of these follow-throughs that we had recently, the quality of the merchandise was kind of junky, right? It's like, well, we had a follow-through day, but I can't find any bases, and I can't find anything that has earnings, or I can't. Don't break the rules. That's not the goal here. You have to still keep the integrity of the rules and buying sound bases, strong fundamentals, the canned slim quality stocks. Some of the fastest money is made in that first several weeks when you see all those breakouts happening. This rally was a little slow to start. When I was reading the big picture, one of the things I noticed was they were talking about the IBD50 and how the IBD50 was lagging, and that's just not normal. So this rally was a little slow to start. Still, you've got to be aware of which stocks are breaking out first. There's usually a 13-week window where your leaders are breaking out, and that doesn't mean that if you miss the first week that you're dead in the water. A lot of stocks are giving you a lot of opportunities in those first few weeks, but you have to be in there. Here's the problem is if you wait until it feels comfortable, a lot of times, then it's too late. And a lot of times those follow-throughs happen when you're the most discouraged, when things are looking the bleakest, and where you're like, the last thing I want to do is buy a stock right now. Yeah.
Okay, just after a rally is good, what do you do?
Great question. What he just was talking about is, let's say you've got 4 or 5 stocks, and you've noticed that you don't really have the leaders. These leaders, a lot of times, will give you other opportunities to buy them. And so I'm always aware of, here are the stocks that I have, here are the stocks that I have that I really like, and here are the stocks that I want to have, that I wish I had. And I'm looking for opportunities to buy those. His question was, at what point will you kind of allow yourself to be maybe initiating a position off the 50-day moving average? Well, sometimes the first time it pulls back, if it's a stock I really want, here again the answer is it depends. It depends on the quality of the stock, the liquidity. I might have been a little bit more hesitant to initiate a position on INVN at the 50-day because of just the nature of its volatility, but a more liquid name, one that isn't quite as volatile, might not have had as big a problem. But yes, I'm definitely looking at those opportunities. They do present themselves. Unfortunately, it becomes a little bit more clear after the fact who the leaders are, and you can kick yourself that you missed them, or you can be Johnny on the spot when they give you an opportunity. This is sometimes where we get a little cute. Sometimes if it's a stock you really want, you might be like, oh, well, it's pulling back to the 21-day. So sometimes there's a little bit of massaging of the rules, but that type of aggressiveness is only happening if you've made some progress or you need to make adjustments and things like that. Again, it depends on your risk tolerance level and how much of that you're going to do. Okay, keep an eye on how your first couple purchases act. You're going to want to get a good sense of the strength of your first couple purchases. Are you making progress on them? Sometimes you didn't buy the right stocks. I can't tell you how many times this has happened to me where it's like, oh, I bought this and I bought this, and oh, I should have bought that and that. Again, you can make adjustments later on. This is the horse race where you get to change your bet in the middle, and that's okay. But you still want to be trying to follow some semblance of rules and be disciplined, not just buying because it's at a new high, because then, of course, you're going to get shaken out much more easy. I mentioned this already, don't be pressured by stocks that lack the sound fundamentals and technicals. Build your watch lists. of the best leaders, the stocks that you want to be in, and keep those on your list. Can you put up cores? This is another example that I can kind of share with you. I had INVN in my portfolio, right? And then cores comes along. And cores was a little bit trickier. Yeah, it was this IPO base, but was it too short and stuff like that. And I know a little bit about both of these companies. INVN, my kids love the Wii. So it's like, okay, they make the chips that are in the Wii, and so that's good. I also own a Michael Kors suit, and I like it. I'm not wearing it today because I've put 12 pounds on during the holiday, and I refuse to have it adjusted. I'm going to go back down 12 pounds, so that's why I'm not wearing the Michael Kors suit today. But the fact was, The other thing that Bill does is he looks and he says, okay, let me get a sense of the history of this particular stock. How often does it beat? By how much does it beat? And again, Bill will never do it this way. He kind of has a sense of where it might be, but you might make some projections of what could be added if it surprises on its estimates and where that would put it. And that's slightly more aggressive. Again, it's not something we're necessarily going to do right now, but it does give you a sense of what the potential is. Here's where the eBay chart is. I'm remembering because I had to type all this up. Yeah, it was based on Bill's notes, and I remember in Bill's notes it was right over here. But yeah, right here is his price target. Now I gave it away. That was going to be like a scavenger hunt, you know, so okay, well, okay. And again, this is educated guesses. Bill is never going to be married to this. He's not going to use it as a sell rule. He's not going to say, well, it hit my target, I'm going to sell now. If it's still acting okay, he might say, well, you know what, based on the earnings that have come out, it might be able to go even further. But this does give him a sense of the potential. He's always got this sense of the potential of his stocks. This is the one that I want to hold on to a little bit longer because I think it has more potential. And again, David will cover some of these things. And again, it really helps him with his hold decisions. Okay, force feeding. We've talked a lot about this, so I'm just going to kind of go over the main points because we've covered a lot of these points just through the course of talking about our portfolio management guidelines. So you figure out which stocks are the real market leaders. You put more money into them. You're shifting money from your lesser performing stocks, again, the ones that are at your bottom, putting those into ones that are at the top. You're determining your leaders by what? Well, number one is price performance, the ones that you're up the most on. How is the stock acting technically? Again, you might not be adding as much to a stock that is a little bit more volatile, and that's okay. If you know yourself, you've made that decision. Looking back on it, you might say, well, why didn't I add at the 50-day? Make a note to yourself. I didn't add at the 50, and this happened to me with INVN. I didn't add at the 50-day because I already had 35% of my account in there, and I didn't want any more. Because if it keeps on doing this, I know that I'm not going to be able to sit with it. 5 weeks or more up in a row. This is something that Bill looks at a lot, especially lately because it's something that he's seen happening so much because that's just evidence of sponsorship. I threw in a couple examples here because in 2009, this is something he kept seeing over and over and over again. So Apple, you know, right here, look at how many weeks up in a row it had. 1, 2, 3, 4, 5, 6, 7, 8, 9 right there. And then 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. That's the institutions that had kind of gotten out of these names saying, okay, time to get back in, right? Same thing happened in Baidu. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. Same thing happened in CMG a little bit later on. I actually owned it at this time, but it had this 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. That's going to be one of those things that gives him some extra conviction. There's evidence that the institutions are getting into this stock. Now, of course, you got to recognize when it's a climax and it's gotten overdone, but this is a very steady increase where the institutions are just buying more shares. They need more of this company exposure in their portfolio. How do you make your additional buys? Wendy actually sat down and created this with Bill. Let's say you have 10,000 shares of each of these stocks, A, B, C, D, E, F, and X, Y, Z. How much you add might vary depending upon the potential of each one and what they look like. So for the first one, it pulls back to the 50-day line on normal volume, and you're up 15% on it, so maybe you'll add 1,000 shares. Okay? And again, calculate what this is going to do to your average cost. That's really important. What is this going to do to my average cost after I make this purchase? What is my gain going to be from my average cost from that point? How much of a cushion am I leaving myself? With DEF, you've got a low average cost, and it's breaking out of a second stage base. You know what? I can get a little bit more aggressive with this one because the second stage base looks pretty good, and it's breaking out of that. So maybe you can be a little bit more aggressive with that one. You've got a bigger gain on it, and it's breaking out of another base. Now, this one is your best performer, and it's bouncing off the 50-day. It's got favorable earnings, favorable sales. You know the story best on this one, and you're up the most on this one. So this is a very aggressive, but again, if you look at what that would do to your average cost, you might say, you know what? It puts my average cost with me still having a 30% cushion. So I'm okay with taking a hit there. And it's still keeping it below my 50-day and stuff like that. And he might actually even do a follow-up buy on something like that. If it goes up 2.5% from that buy, sometimes he'll make a follow-up buy on his ad, trying to funnel more money into those leaders. That's what's happening right here. XYZ day 2, it quickly goes up another 2% on huge volume. And so his average cost got dropped down to 40 in this case, but he's still got a lot of cushion. He can still be aggressive. Does that make sense? Okay. Looking for additional buy points, and as I mentioned, you want to be cognizant of those buy points that are presenting themselves in maybe leaders that you missed, or in the leaders that you own, a chance to get more heavily invested if it's still within your limit. If you found that your limit is 35, 40%, it doesn't mean you have to keep on adding if that's not comfortable for you. The first couple of pullbacks to the 50-day moving average, and notice this says the first couple, not any time it pulls back to the 50-day moving average, because as it gets to be the fourth, fifth, now you're getting a little extended, and you don't want to be getting too aggressive later on in the game. Your time to be aggressive is kind of earlier when you've got the good cushion, but it's still early in the move. Later on, as it's done this 5 times, that's getting a little bit late. 3 weeks more tight, second, third stage bases, and again, raising the capital, you're going to sell a portion or all of your laggard stocks. How much you add, again, here's that word, depends. You know, how much you add, what your average cost is, how much you're up on it, the product cycle. Sometimes you're looking at a restaurant. Is it a restaurant that's well established, or is it one that has just a few restaurants and it can expand across the country or internationally? The liquidity, what stage base was the last breakout out of, and what your price targets are and your current position size. Again, you might be a little less aggressive if you've already got a big position size in it. So always be aware of your position sizes when force feeding. Also, this is very important, don't get too top heavy, okay? Don't let your average cost creep up too much, because again, if you lose that cushion, it's going to be much harder for you to handle a normal correction. Be prepared to act if something goes wrong, especially the more you get aggressive. Know what that normal correction is going to be, but if you start seeing signals, you might have to back away a little bit. It doesn't mean you have to sell everything, but you might have to back away just to kind of keep the pressure off you. Or if you see distribution in the market, you might have to back away a little bit. Watch the market action of leaders and the price and volume of the general market. Again, you might have to reduce your exposure because of the market and be ready to act in that way. With this force feed method, the ones that you're up the most on should be the ones that have the biggest percent of your equity.